Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Medical System Holdings Limited annual report. China Medical System Holdings Limited offers a wide range of pharmaceutical products across various therapeutic areas. In the cardiocerebrovascular segment, the company provides medications such as VLPHORO for seizure clusters and Xinhusu for acute heart failure. In gastroenterology, China Medical System Holdings Limited offers METOJCT for severe psoriasis and rheumatoid arthritis, LUMEBLUE for colorectal lesion visualization, Salifalk for ulcerative colitis and Crohn's disease, Bioflor for diarrhea, Combizim and Cytine for digestive enzymes, and Ursifalk for cholesterol gallstones. The company also has a dermatology portfolio that includes ILUMETRI for plaque psoriasis, Ethoxyclarol for varicose veins, Hirudoid for skincare and acne treatment, V-Monalisa for dermal implantation, Ogentrophin Stuln Mono Eye Drops for asthenopia, Iopone glaucoma treatment device, and Elcitonin for osteoporosis pain. In addition to these products, China Medical System Holdings Limited provides other services including modified sodium hyaluronate filler, eye drops, and a glaucoma treatment device. The company was founded in 1995 and is headquartered in North Point, Hong Kong. China Medical System Holdings Limited market capitalization of $32 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that China Medical System Holdings Limited holds a significant advantage in their industry. China Medical System Holdings Limited trades at a higher price-to-earnings ratio of 17 times and a higher price-to-book ratio of 1.62 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 9% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The company have a dividend yield of 2.62%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. Revenue growth and decline can be attributed to several key factors. On the growth side, sales of exclusive and innovative products have been a major driver, with a significant increase of 44.1% in the sales of these products. The launch of new products has also contributed to revenue growth, as well as the entry into agreements with other companies, such as Novartis Pharma Services AG. Additionally, obtaining rights to innovative drugs and collaborating with other pharmaceutical companies have further boosted revenue. Furthermore, the continued growth in sales of exclusive and innovative products has been a consistent trend, contributing to overall revenue growth. This is evident from the 23.3% year-on-year increase in sales of key exclusive/branded products and innovative medicines. On the decline side, a decrease in promotion income has been a significant factor, resulting in a loss of RMB 24,044. Additionally, a decrease in allowance for credit losses has also contributed to revenue decline, with a reduction of -$1,723 to -$9,533. These factors have had a negative impact on overall revenue, highlighting the importance of managing these aspects effectively to maintain growth and stability. The company's net income experienced a significant decline of 10.5% year-over-year, resulting in a net income of RMB 1,443.3 million. This decrease is a notable change from the previous year. On the other hand, profit margin saw a slight drop of 1.1 percentage points to 71.5%. However, it's worth noting that sales from key exclusive and branded products showed a substantial growth of 23.3% year-over-year, accounting for nearly 60% of total turnover. This indicates that while the company's overall profit margins may have decreased, its focus on high-margin products has helped to mitigate this decline. The company's debt level and interest expenses have undergone significant changes in recent years. According to the extracted summaries, interest-bearing bank borrowings decreased from RMB 831,300 in 2024 to RMB 651,815 in 2025, indicating a reduction of RMB 179,485. This decrease is consistent with the information provided on page 56, which states that bank borrowings have decreased significantly. In terms of interest expenses, finance costs have also seen a notable decline. The summaries reveal that finance costs decreased from RMB 38,610 to RMB 20,297, representing a reduction of RMB 18,313. Furthermore, the decrease in finance costs is even more pronounced when expressed as a percentage, with a 47.4% drop from RMB 38.6 million to RMB 20.3 million. Overall, these changes suggest that the company has made efforts to reduce its debt level and interest expenses, which could have positive implications for its financial health and stability. The performance of various segments and regions within a company has been analyzed. The integrated business segment stood out as a strong performer, with notable revenue, gross profit, and profit figures. In contrast, the skin health business segment struggled, recording lower revenue, gross profit, and incurring a loss for the period. On a regional basis, the elimination segment was identified as underperforming, with negative intersegment revenue and a significant loss for the period. These results indicate areas where the company may need to focus on improvement or realignment of resources to optimize performance. The company has a history of rewarding its shareholders through various means. One such way is by paying dividends, which is a clear indication that the company values its investors' interests. According to the provided information, the company has indeed paid dividends on multiple occasions, as mentioned in pages 17, 27, and 59. In addition to dividend payments, the company has also been involved in share buybacks. This strategy allows the company to repurchase its own shares from the market, thereby reducing the number of outstanding shares and potentially increasing earnings per share for existing shareholders. The company's decision to engage in share buybacks suggests that it is committed to maximizing shareholder value. Overall, these actions demonstrate the company's commitment to its shareholders and its desire to create long-term value through various means. There are growing concerns among industry experts regarding the potential for inventory buildup and supply chain disruptions. The issue of inventory buildup is a pressing concern, as highlighted on page 54 of a recent report. This problem can have far-reaching consequences, including wasted resources, increased costs, and decreased efficiency. The root causes of inventory buildup are multifaceted, but they often stem from overproduction or underestimation of demand. When companies produce more products than they can sell, it leads to an accumulation of unsold goods, which in turn can cause a ripple effect throughout the supply chain. This can result in wasted resources, including raw materials, labor, and storage space. Supply chain disruptions are another significant concern, as they can have devastating effects on businesses and economies. Disruptions can be caused by various factors, including natural disasters, transportation issues, or unexpected changes in demand. When a disruption occurs, it can lead to delays, shortages, and increased costs, ultimately affecting the bottom line of companies. To mitigate these risks, companies must adopt more agile and responsive supply chain strategies. This includes implementing just-in-time production, improving forecasting techniques, and building stronger relationships with suppliers and customers. By doing so, businesses can better manage inventory levels, reduce waste, and minimize the impact of disruptions when they occur. That concludes the financial summary for China Medical System Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.